Welcome to Herd Mentality, a podcast from StoneX where we discuss global dairy markets and what's driving them. It's important to remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss. Past results are not necessarily indicative of future results. Welcome to episode 1 of Herd Mentality. Over the past month, the biggest move that we've seen for dairy prices has been CME spot cheese prices and consequently Class 3 milk prices here in the U.S. I wanted to talk to Dave Kurzawski, who's our team lead for the Dairy Risk Management Group in Chicago. Dave, how long have you been with StoneX?
Great, Nate. Thanks for having me on. It's a pleasure to be here for the first ever Herd Mentality podcast. Looking forward to many more going forward. I've been with StoneX, in the dairy market since 2002, and since 2008 with StoneX. So, in that time, we've seen a lot of changes in the dairy industry, but which has been really great to be a part of. So just encroaching on about 15 years.
Yeah, that goes back to the infancy of the Class 3 market, which has made some pretty big moves here. I think the June contract is up about $5 over the past month, with spot cheese up about 50 cents a pound. What do you think's been driving that?
Oh, man, there's a lot to unpack, Nate. And I don't know that we have all the answers just yet on this cheese move that has happened here in the last month. But it's happened very quickly. And, I'd like to point out before we go into that, sometimes it's worth taking a big step back and looking at the cheese market, or any market for that matter. Prior to COVID, we always used to talk about an 18 to 24 month bear market cycle for Class 3 milk principally, but just dairy in general. And, if you look back over the last couple of years, I mean, the peak that we saw, which I think was around $2.40 a pound, the last peak, and we won't include the 2020, 2021 COVID years that were kind of disjointed by government purchases and those kinds of things. But in 2022, we peaked in April of 2022 and then spent the next 24 months going down. And then in April of 2024, market turned on a dime essentially, and we rallied that 50 cents that you're talking about. So it's kind of interesting. It's like, are we going back into a pre-COVID type of 18 to 24 month cycle? I know people sometimes think there's a 3-year cycle. I'm not really sure, but I would say that it's been a number of things. Obviously, we've been in kind of an inflated economy. Inflation is, although under a little bit of stability right now, and the Fed has done a good job of tamping inflation down. I think when we look back at this time in history, it's generally marked by inflation. And I think typically that's a helpful thing for farmers, but in the fog of inflation, there are periods of price movements for the commodity that the farmer sells that are going to be problematic, unprofitable. And so I think we've gone through that period over the past, let's call it 18 months or so. And so the seeds of this rally potentially were sown, even more than 12 months ago. And so I think what has happened is the cost of operating a dairy farm have gone up tremendously, which wouldn't matter if we were all getting paid $20 all the time. But we were, had the market had come down into the 140s, and we could cite demand. Demand really, I think, being the principal driver of weak prices for the past year or more, cheese demand, that is. And so I think, you've got some tightness on milk supply out there just naturally by virtue of the fact that profitability has been questionable for some dairies. And even worse than that for others. So I think there's been some tightness there on the milk supply side of things. There's also issues with the availability of fresh heifers out there that I think is maybe more of a handicap going forward. But, the reality of it is that there has been very, very little expansion or interest in capital investment in dairy farms in the U.S. These guys are just trying to keep their head above water. And on top of that, now you've added this avian flu. And the really finder of fact is probably out somewhere ahead of us. We don't know, how many dairies have it, and we don't know how bad it is for each dairy. We have some assumptions that we can make, but my guess is it's worse than we think. And I think that is just the last in a string of things that have happened on farm that have basically tightened the milk supply in the U.S. And I think it doesn't much matter when demand is soft. In fact, maybe prices would have been lower than $1.40, $1.50, where we kind of spent most of the first quarter on cheese, had milk production been higher, or had cheddar production been higher. U.S. cheesemakers have done a good job of not overproducing cheese in this environment. So now you've got the supply side of the equation that's a little bit more constricted than we would normally see, and demand was weak, and life moved on pretty easily in the 140s. Well, as soon as that demand turns around, I think it exposes the fragility of the supply chain. And that's what we're seeing here.
Wow. All right. There's a lot of things to circle back in there. I think just for clarity, you threw out a comment that inflation's good for farmers. And I think what you're saying is that the general inflation in the economy tends to increase both their input costs, but eventually it increases the revenue that they're receiving as well, the dairy product prices and the milk prices.
Correct.
Yeah. But then secondarily, you said that we often see a 18, 24 month bear cycle on cheese pricing. Have you looked at the flip side of it and said, okay, how long does the bull cycle tend to last?
Yeah, that's a great question. Because obviously we've made new highs, and new ground to the upside over the last 20 years in the price of cheese. And the thought there is that it's probably more like 6 to 12 months.
Okay.
I think, but again, you look at a situation like 2014 when we get over $2. At that time, I don't believe we had spent more than, I want to say 10 or 11 weeks over $2. We ended up spending 12 months over $2. It might have even been like less than 11 weeks. It might have been like 5 or 6 weeks. I have to go back and look. That's 10 years ago. But I want to say at that time, we got into the $2 market, and the thought was by, myself and other analysts, well, this doesn't last forever. We see this happen. It's like 3 to 4 weeks, and the market kind of corrects itself, clears up some high price product, and things come down. And then we spent the whole year over $2. That was more of a demand-driven market. What I think is unique about what's going on in dairy today is that, in my opinion, it seems to be more supply-driven than demand-driven. I think the risks, if there are weakness to price out there, and we will have setbacks on price, I think the risks there lie on the demand side. But I think we're going to be faced with tighter milk supplies and kind of this discussion around the availability of both fresh milk and then ultimately fresh cheese, which is what we price here at the exchange, at least in the spot market. That's going to be a debate or a discussion or a fact of life I think we're going to deal with all year.
Well, the USDA is set to release the April milk production report next Monday on April 20th. So that'll give us another read on how the supply side is actually doing. With that, I'll thank you, Dave, and I'll wrap it up.
Thank you, Ned. Appreciate it.
All right. Take care.
Bye-bye.
The U.S. cheese market has been a big mover, but I was also caught off guard this week by the strength that we saw in European skim milk powder futures. If we roll back to Tuesday of this week, the GDT Pulse event saw skim milk powder prices for Fonterra's medium heat product fall by 2.2%, down to about 2,300 euros a ton, which is $1.12.5 per pound. And I thought that would be pretty bearish for the European and US skim markets, but instead we saw European skim milk powder futures rally on Tuesday. So I wanted to have on Fearghal McCabe, who's our head of EU dairy brokerage. Welcome, Fearghal. And how long have you been with StoneX?
Thank you, Nate. Yeah, thanks for having me on. It's a privilege to be on the first episode of Herd Mentality. I also like the name. Yeah, so to give a bit of background on myself, Fearghal McCabe is my name. I grew up in Ireland, about an hour outside Dublin. I actually come from a farming background of grains. My family run a grain and potato farm in County Meath in Ireland. I studied agricultural business in University College Dublin. Spent a little bit of time with that course in Michigan State University. So, and that's where I first interacted with the commodity market. So learning about those through the US markets, both grain and dairy. Then I came home back to college for a year and started an internship with StoneX. That was in early 2016. I started with StoneX on the grain side of the business, and shortly after moved over to the dairy side. So I've been with StoneX here in Dublin, working on the European dairy market for almost 8 years, or just over 8 years. Sorry.
Yeah, I didn't realize that I started December of 2015, so we started almost exactly the same time.
Yeah.
It's felt like longer, but so we saw this strength in the skim milk powder futures, which was running counter to the Pulse event. Do you have any feeling for why we've seen that strength in European skim?
Yeah, it all started a little bit. So the market had been trending. I guess there's been a bit of a bearish trend on the skim milk powder over here since around last year's kind of October area. If you look back through the charts on Plus, you'll see, that market consistently trending lower. And I think that's been the position that the market has taken over here, particularly on the trader side of the market. Then I guess it was the GDP auction last week just showed stronger results, I think, than the market was expecting over here. I think there was a bit of a change probably on the offered prices on the physical market. And on the future side, it just seems to have, over the last 6 weeks or so, bottomed out a little bit on the skim milk powder. And I think that stronger than anticipated GDP result across the board brought a little bit of buying back into the market. That continued through. There was European holidays the end of last week. That continued through to the end of last week. It kind of rebounded about 50 to 75 euros. And carried over into this week. Like yourself, I thought maybe the result on the GDP pulse would take a little bit of heat out of the market, but it seems on the physical side, the offer prices on the physical are higher, and we've moved now. I think the low we traded on Q3, probably early last week, was 24.35 for the Q3 futures, and they've traded today, just before coming in here at 2,600. So an increase of 165 euros across the last 2 weeks, and that's probably the most aggressive buying we've seen in the skim milk powder market for, since mid to late last year, really.
That's a really good point. I hadn't considered it, that the GDT event on May 7th was stronger than expected. And actually that marked the bottom for the spot non-fat market in the US as well. And we've strengthened since then. So now that you pointed out, GDT Pulse is kind of the odd man out here. We're seeing strength in the spot market in the US. We're seeing it in Europe. We saw it at the GDT event on the 7th. It's really only that GDT Pulse event this week on the 14th where we saw weaker skim pricing. So stronger skim pricing in Europe. What's happened on the butter side?
On the butter side, this week we've had a move. I guess it spent probably 6 weeks or so prior to this week hovering around that kind of 6,000 to 6,200 level for the remainder of this year. And I guess the market, from my perspective, had that feeling of potential to go higher. And I think that feeling was there across the market. So it's been very nervous. And this week we've kind of seen that move higher. So we've moved from, I would say last week or the week before, kind of that crossing over the weekend, we were still in around that 6,200 level for Q3. And we've moved up now to where it's shaping up today around 6,600 to 6,650. The market has been trading, I guess, lower than normal volumes. And I think that's reflective of the nervousness in the market for butter, but also just feels like a lack of availability of product also on the physical side. So we see an aggressive move up for this Q3 and Q4 of this year, in around that 6,600 level. But we still see, the first half of next year probably shaping up in more around 6,300. So we're seeing a drop off into next season. And that's kind of normal, I guess, is the third time I've seen butter have a rally at these higher prices. And I think that's reflective of what we see when they increase kind of into this mid 6,000s, that we see a big drop off into the next season or on the deferred contracts.
Yeah, I mean, our expectation is European milk production is going to improve in the second half of 2024 into early 2025. And that will help out the butter production and start to rebuild these inventories. But the March production data for Europe just came out, and butter production was down about 8.3% from last year in March, which is a larger than expected decline in production. So it does look like the near-term fundamentals are still supportive for European butter prices. With that, I want to thank you for the time and insights, Fearghal.
No problem, Nate. Thank you very much.
All right. Take care.
Cheers. Bye-bye.
The StoneX Dairy team spans the US, EU, Asia, and Oceania, providing market intelligence, analysis, and forecasts through our interactive data platform called StoneX Plus, as well as full-service brokerage on the major dairy exchanges, the CME, EEX, and SGX. If you're interested in finding out more about our market intelligence or brokerage services, you can find more information on stonex.com.
This communication is issued in the European Economic Area by StoneX Financial Europe SA, SFE by the SFE presenters noted. This communication is issued in the United States by FCM Division of StoneX Financial Inc., SFI, by the SFI presenters noted. And the material should be construed as the solicitation of trading strategies and / or services provided by SFI. StoneX is the trade name used by StoneX Group Inc. and all its associated entities and subsidiaries. StoneX Group Inc. companies provide financial services worldwide through its subsidiaries, including physical commodities, securities, exchange-traded and over-the-counter, under derivatives, risk management, global payments, and foreign exchange products in accordance with applicable law in the jurisdictions where services are provided. References to certain over-the-counter products or swaps are made on behalf of StoneX Markets, LLC SXM, a member of the National Futures Association NFA and provisionally registered with the U.S. Commodity Futures Trading Commission CFTC as a swap dealer. SXM products are designed only for individuals or firms who qualify under CFTC rules as an eligible contract participant and who have been accepted as customers of SXM. Wealth management is offered through SA Stone Wealth Management Inc., member FINRA/SIPC, and SA Stone Investment Advisors Inc., and SEC Registered Investment Advisor, both wholly owned subsidiaries of StoneX Group Inc. StoneX Financial Limited SFL is registered in England and Wales, company No. 5,616,586. SFL is authorized and regulated by the Financial Conduct Authority registration number FRN 446,717 to provide to professional and eligible customers including arrangement, execution and, where required, clearing derivative transactions in exchange-traded futures and options. SFL is also authorized to engage in the arrangement and execution of transactions in certain OTC products, certain securities trading, precious metals trading and payment services to eligible customers. SFL is authorized regulated by the Financial Conduct Authority under the Payment Services Regulations 2017 for the provision of payment services. SFL is a Category 1 ring dealing member of the London Metal Exchange. In addition, SFL also engages in other physically delivered commodities business and other general business activities which are unregulated and not required to be authorized by the Financial Conduct Authority. StoneX Financial Europe SA. SFE is a securities trading firm registered in the Grand Duchy of Luxembourg under Company No. RC Lux B 10821. SFE is authorized by the Luxembourg Ministry of Finance and regulated by the Commission de Surveillance du Secteur Financier Registration No. P00000 to carry out, inter alia, the activities of investment advisor, portfolio manager, professional acting on own account, broker in financial instruments, and commission agent. Stone X Financial T. Limited, Co. Reg. No. 201,130,598 RSFP holds a capital market services license and is regulated by Monetary Authority of Singapore Massive for dealing in exchange-traded derivatives contracts, OTC derivatives contracts and spot foreign exchange contracts for the purposes of leveraged foreign exchange trading. Stone X Financial HK Limited C. No. BCQ 152-HK is regulated by the Hong Kong Securities and Futures Commission for dealing in futures contracts. Stone X Group Inc. acts as agent for SFL in New York with respect to its payment services business. Stone X Financial T. Limited acts as agent for SFL in Singapore with respect to its payment services business. Trading swaps and over-the-counter derivatives, exchange-traded derivatives and options and securities involve substantial risk and is not suitable for all investors. These materials represent the opinions and viewpoints of the author and do not necessarily reflect the viewpoints and trading strategies employed by the FCM division of SFI or SXM. These materials represent the opinions and viewpoints of the author and do not necessarily reflect the viewpoints and trading strategies employed by the FCM division of SFI or SXM. The information herein is not a recommendation to trade nor investment research or an offer to buy or sell any derivative or security. It does not take into account your particular investment objectives, financial situation, or needs and does not create a binding obligation on any of the Stone X Group Inc. of companies to enter into any transaction with you. You are advised to perform an independent investigation of any transaction to determine whether any transaction is suitable for you. No part of this material may be copied, photocopied, or duplicated in any form by any means or redistributed without the prior written consent of Stone X Group Inc. Copyright 2024 Stone X Group Inc. All rights reserved.